Right now, while most people are distracted by headlines, politics, and paper promises, something historic is happening in the silver market. The smart money sees it. Central banks know it. Industrial demand is exploding. Supply is tightening. And yet the average investor still has no idea what's coming next. This is not just another price move. This is not another temporary rally. What we are witnessing could become the greatest wealth transfer in precious metals history. And if silver breaks through the levels experts are watching, the road to 1,000 silver may no longer sound impossible. It may become inevitable. Tonight, I'm going to show you why silver holders must pay attention right now, because the window to prepare may be closing faster than anyone realizes. For decades, the world treated silver like an afterthought. Investors chased stocks, governments printed currency without limits, and financial media spent most of its time talking about technology companies, real estate booms, and central bank policies. Silver sat quietly in the background, misunderstood, undervalued, and ignored by the majority of the public. But beneath the surface, something dangerous was building. A structural imbalance began forming inside the global silver market, and now that imbalance is becoming impossible to hide. Most people assume silver is simply another precious metal, something investors buy during uncertain times alongside gold. What they fail to understand is that silver is not only a monetary metal, it is also one of the most important industrial resources in the modern world. Unlike gold, which is mostly stored and preserved, silver is consumed. It is used in electronics, solar panels, electric vehicles, medical technology, military equipment, semiconductors, batteries, satellites, communication systems, and hundreds of industrial applications that power modern civilization. Every year, massive quantities of silver disappear into manufacturing, never to return to the market in recoverable form. This is where the real problem begins. Demand is accelerating at a pace the mining industry cannot keep up with. Governments are pushing green energy transitions across the globe. Solar energy production is exploding. Electric vehicle manufacturing is increasing rapidly. Artificial intelligence infrastructure requires enormous technological expansion, and every layer of that infrastructure depends on conductive materials. Silver happens to be one of the best conductors of electricity on Earth. That means the very technologies governments and corporations are promoting as the future are quietly consuming the silver supply at historic rates. At the same time, silver production is not growing fast enough to satisfy this rising demand. Most silver mines around the world are not primary silver mines. Silver is often produced as a byproduct of mining for copper, zinc, or lead. This creates a dangerous bottleneck because silver production cannot simply be increased overnight. Even if silver prices surge, miners cannot instantly expand output. Opening new mines takes years, sometimes decades, due to environmental regulations, political barriers, labor shortages, financing problems, and declining ore quality. The public rarely hears about declining ore grades, but this issue is critical. Miners today must process far more rock to extract the same amount of silver that previous generations could obtain with much less effort. Production costs rise while efficiency falls. Energy prices continue climbing, transportation costs increase, and geopolitical instability disrupts supply chains. Every part of the mining process becomes more expensive and more fragile. Yet, despite these realities, the financial system continues pricing silver as if supply is endless. This disconnect between reality and price is one of the most important stories in the financial world today. Physical silver availability is tightening, while paper markets continue creating the illusion of abundance. Futures exchanges, derivative contracts, leveraged products, and synthetic trading systems allow massive amounts of paper silver to exist without corresponding physical metal backing it. In many cases, there are claims to silver that exceed the actual silver available for delivery. Imagine a system where hundreds of people believe they own the same asset. Everything appears stable until too many participants demand physical delivery at the same time. Then the illusion breaks. That is the hidden danger sitting inside the silver market today. The financial world has become addicted to leverage, speculation, and artificial pricing mechanisms. As long as confidence remains intact, the system functions. But once confidence weakens, panic spreads quickly. This is why experienced precious metals investors pay close attention to physical inventories. When inventories decline while industrial demand rises, pressure begins building beneath the surface. It is similar to a fault line before an earthquake. Most people see calm conditions above ground, but stress is accumulating underground. The silver market is showing those same warning signs. Over the last several years, inventories on major exchanges have experienced increasing pressure. Large withdrawals from vaults have raised questions about long-term availability. Industrial buyers are becoming more aggressive in securing supply agreements. Nations concerned about strategic resources are paying closer attention to precious metals markets. Meanwhile, retail investors continue purchasing physical silver bars and coins whenever economic uncertainty rises. This creates a multi-layered demand structure, unlike anything seen in previous decades. Industrial users need silver because modern technology cannot function without it. Investors want silver because fiat currencies are losing purchasing power. Governments are monitoring silver because strategic metals are becoming critical in geopolitical competition. All of these forces are colliding simultaneously while mining supply struggles to respond. The average person still does not understand how serious this situation could become. They look at silver prices and assume there is no shortage because the price has not yet exploded. But markets do not always react gradually. Sometimes pressure builds silently for years before releasing violently in a very short period of time. History is filled with examples of markets that appeared stable until suddenly they were not. Oil shocks, banking crises, housing collapses, currency devaluations, and commodity shortages often emerge after long periods of complacency. Silver may be approaching a similar moment. The warning signs are already visible to those paying attention. Supply deficits are growing. Industrial demand records are being broken. Exploration spending remains insufficient relative to future needs. Global debt levels continue rising, forcing governments to rely on monetary expansion that weakens currency confidence. As confidence in paper assets declines, investors naturally search for stores of value. Gold historically attracts attention first because it is viewed as monetary protection, but silver often follows with much greater volatility because its market is far smaller. It takes far less capital entering the silver market to create dramatic price movements. This is why silver historically experiences explosive rallies during periods of monetary instability. What makes the current environment especially dangerous is the combination of industrial necessity and monetary uncertainty occurring at the same time. In previous cycles, silver demand was often driven primarily by investment fear or economic speculation. Today, industrial consumption alone is creating enormous pressure before widespread investment panic has even begun. If a major financial crisis erupts while industrial demand remains elevated, the competition for physical silver could intensify rapidly. This is the scenario many analysts refuse to discuss publicly because it challenges confidence in the existing financial system. Modern economies depend heavily on trust. Governments need people to trust currencies. Banks need people to trust deposits. Markets need investors to trust liquidity. But trust becomes fragile when inflation rises, debt spirals out of control, and supply chains weaken. Silver sits directly at the intersection of all these vulnerabilities. It is both an industrial necessity and a monetary escape route. That combination makes it uniquely powerful during times of systemic stress. If industrial users become desperate for supply while investors rush toward hard assets simultaneously, the market could face a shock unlike anything seen before. Some experts believe the current pricing structure in silver is unsustainable. They argue that paper markets have suppressed natural price discovery for years through leverage and synthetic supply creation. According to this perspective, the real value of silver has been distorted by financial engineering rather than determined by true physical availability. Whether one fully agrees with that argument or not, the imbalance between physical demand and available supply is becoming increasingly difficult to ignore. Even major industries are beginning to acknowledge the problem. Manufacturers are discussing supply chain risks more openly. Renewable energy expansion plans require enormous quantities of silver. Military technology advancement depends on silver-intensive components. Semiconductor production relies heavily on conductive materials. Every major technological trend of the future appears connected to rising silver demand, yet the public conversation remains strangely quiet. Financial television spends endless hours debating interest rates, stock valuations, and cryptocurrency trends while barely mentioning the structural supply challenges developing in the silver market. This silence creates opportunity for those paying attention early. Historically, the largest wealth transfers occur before the majority recognizes what is happening. By the time headlines dominate mainstream discussion, much of the move has already occurred. This is why experienced investors study fundamentals rather than emotions. They look beyond short-term price fluctuations and focus on long-term structural trends. In silver's case, those trends are becoming increasingly powerful. Rising industrial demand, constrained mine supply, declining ore grades, inflationary monetary policies, geopolitical instability, and growing distrust in fiat systems are all pointing toward the same conclusion. Pressure is building inside the silver market at a historic scale. The idea of a global silver shortage once sounded extreme to many people. Today it is becoming harder to dismiss. The numbers tell a concerning story. Annual demand continues outpacing annual supply in multiple sectors. Strategic competition between nations is intensifying resource acquisition efforts. Renewable energy mandates are accelerating silver consumption. Physical investment demand remains resilient despite market volatility. At some point, markets must reconcile paper expectations with physical reality. When that happens, pricing mechanisms can change very quickly. The danger for unprepared investors is assuming there will always be time to react later. But when shortages become obvious to the public, premiums surge, inventories disappear, and access becomes more difficult. This has happened repeatedly throughout commodity history. The people who prepare early generally benefit most while late participants struggle to secure positions. There is also a psychological component many overlook. Markets are driven not only by supply and demand but by perception. Once the perception of scarcity takes hold, behavior changes rapidly. Buyers become more aggressive. Sellers become more reluctant. Panic buying emerges. Hoarding begins. Media attention intensifies. Momentum feeds itself. In tightly supplied markets, these behavioral shifts can produce extraordinary price acceleration. Silver's relatively small market size amplifies this risk dramatically. Compared to global equity or bond markets, the silver market is tiny. That means even modest capital inflows can create significant price distortions. If institutional investors, hedge funds, pension managers, or sovereign entities begin increasing silver exposure simultaneously, available supply could tighten extremely fast. Many people underestimate how quickly sentiment can shift during financial stress. One major banking crisis, one severe recession, one currency shock, or one geopolitical escalation can completely alter investor psychology almost overnight. Suddenly, assets previously ignored become highly desirable. Silver has historically benefited during such transitions because it combines tangible value with monetary history. Unlike digital numbers on a screen, physical silver carries no counterparty risk. It cannot be printed into existence by central banks. It does not depend on a corporation's earnings report or a government's fiscal discipline. Its value is rooted in scarcity, utility, and thousands of years of monetary recognition. That reality becomes more important during periods when trust in institutions begins weakening. This is why the global silver shortage story matters far beyond the metals market itself. It represents a warning sign about broader systemic fragility. Modern civilization depends on complex supply chains functioning smoothly across energy, technology, manufacturing, transportation, and finance. When critical materials become constrained, vulnerabilities spread across the entire system. Silver may be revealing stresses that extend far beyond one commodity alone. Every major economic transformation throughout history required key strategic resources. Industrial revolutions needed coal and steel. Oil powered the 20th century. Rare earth minerals became essential for modern electronics. Silver is increasingly becoming one of the foundational resources of the emerging technological era. The problem is that demand growth is accelerating faster than public awareness. For years, the silver market remained overshadowed by larger financial stories, but conditions are changing. Inflation pressures continue damaging purchasing power globally. Governments remain trapped in debt cycles requiring continued monetary expansion. Industrial demand keeps breaking records. Supply limitations grow more severe. Confidence in traditional systems weakens gradually while alternative stores of value gain attention. The convergence of these forces is creating one of the most fascinating and potentially explosive setups in modern financial history. What appears today as a quiet commodity market could eventually become the center of a major global repricing event. Those studying the underlying fundamentals understand that shortages rarely announce themselves politely in advance. They build slowly, silently, and invisibly until the moment the world suddenly realizes the supply was never as abundant as everyone assumed. For years, central banks and major financial institutions publicly dismissed precious metals as outdated assets. Television analysts mocked gold and silver investors as paranoid relics preparing for disasters that never came. Governments encouraged populations to trust fiat currencies, digital banking systems, and debt-driven economies. The official narrative was clear: modern financial systems were stable, inflation was temporary, and central authorities had everything under control. But behind closed doors, the actions of the world's most powerful financial players told a very different story. While the public focused on stock market rallies and artificial economic optimism, central banks around the world quietly began accumulating hard assets at historic levels. Gold purchases surged among nations seeking protection from geopolitical instability and currency uncertainty. Strategic resource acquisition intensified globally. Countries started repositioning themselves for a future where trust in paper systems could weaken dramatically. Although gold received most of the attention, silver slowly emerged as a metal impossible to ignore because of its dual role as both money and industrial necessity. Large institutions understand something the average person often misses. Real power in the financial world does not come from headlines or public statements. It comes from preparation. Institutions do not wait until crises become obvious before positioning themselves. They study trends years in advance. They monitor supply chains, debt structures, geopolitical risks, energy markets, industrial production, and monetary policies long before those issues dominate mainstream conversation. By the time the public recognizes danger, the most powerful players are usually already positioned. This is exactly why the behavior surrounding precious metals has become so important. Central banks may publicly support confidence in fiat currencies, but their own actions reveal deep concern about the future stability of the global financial system. Nations are increasing reserves. Countries are reducing dependency on foreign currencies. Strategic alliances are shifting. Trade settlements outside the traditional dollar-based system are expanding. All of these developments point toward one reality: global trust in the existing monetary order is slowly changing. Silver occupies a unique position inside this transformation. Unlike gold, silver's importance extends far beyond monetary protection. It sits at the heart of industrial infrastructure. Every major technological advancement depends on it in some form. Renewable energy systems require it. Electric vehicles need it. Military applications rely on it. Medical industries use it. Telecommunications depend on it. Semiconductor production cannot function efficiently without it. This makes silver not only a financial hedge, but also a strategic national resource. Governments understand this far better than the average investor. Nations preparing for future economic instability recognize that controlling strategic resources may become just as important as controlling energy supplies. In a world moving toward electrification, digital infrastructure, artificial intelligence, and advanced defense systems, silver becomes increasingly critical. The more the global economy modernizes, the more silver demand expands beneath the surface. This creates a dangerous contradiction inside the financial system. Publicly, many institutions still treat silver like a volatile commodity with limited importance. Privately, industrial planners and strategic analysts understand that silver shortages could disrupt entire sectors of the global economy. This gap between public messaging and private concern is where opportunity begins to emerge. Major financial institutions rarely reveal their true positions immediately. They prefer accumulation during periods of low public interest. Quiet positioning allows them to secure exposure before markets become crowded. History repeatedly shows that institutions accumulate assets when sentiment is weak and distribute assets when public excitement reaches extremes. In silver's case, much of the public still remains unaware of the structural pressures developing underneath the market. That gives institutions valuable time to prepare. At the same time, Central banks are facing challenges unlike anything seen in modern economic history. Global debt levels have exploded beyond sustainable limits. Governments owe trillions upon trillions in obligations they cannot realistically repay through normal economic growth. The only politically acceptable solution has been monetary expansion, more currency creation, more liquidity injections, more stimulus programs, more debt monetization. This strategy temporarily stabilizes economies, but it comes with consequences. Every time more currency enters the system without corresponding increases in real productivity, purchasing power weakens over time. Inflation becomes embedded structurally within the economy. Central banks may attempt to manage inflation through interest rate adjustments, but the deeper problem remains unresolved. Debt-based systems require constant expansion to survive. The moment expansion slows significantly, recessionary pressures intensify. Institutions understand this trap. They know modern economies are caught between inflation and collapse. Raise interest rates too aggressively, and debt markets begin breaking. Lower rates too much, and currency confidence deteriorates. Continue printing money, and inflation accelerates further. Stop printing, and liquidity crises emerge across financial systems dependent on endless cheap capital. This environment naturally drives smart money toward tangible assets with intrinsic value. Real estate, commodities, energy resources, agricultural assets, and precious metals all become increasingly attractive during periods of monetary uncertainty. Silver stands out because it combines scarcity, industrial necessity, and historical monetary recognition within one asset. Another factor institutions are quietly monitoring is geopolitical fragmentation. For decades, globalization created the illusion of permanent economic integration. Supply chains stretched across continents. Nations became heavily dependent on one another for manufacturing, energy, technology, and trade. But recent years exposed how fragile those systems truly are. Wars, sanctions, trade disputes, pandemics, shipping disruptions, and political tensions revealed how quickly global supply networks can fracture. Silver supply chains are vulnerable to these same disruptions. Mining operations depend on stable governments, energy availability, transportation infrastructure, labor access, and investment capital. Any instability within these areas can reduce production significantly. Institutions analyzing long-term risk models understand that future silver supply may become far less predictable than markets currently assume. At the same time, demand projections continue climbing aggressively due to industrial transformation. Renewable energy expansion alone requires enormous quantities of silver. Solar panel production has become one of the fastest growing demand drivers globally. Governments promoting green transitions often fail to acknowledge the raw material requirements necessary to support those ambitions. Electric grids, charging infrastructure, battery systems, and advanced electronics all depend on silver-intensive technologies. This means governments are indirectly creating future silver demand explosions through their own policies. While publicly discussing climate goals and technological innovation, they are simultaneously increasing dependency on a metal facing growing supply pressure. Institutions paying attention to these dynamics recognize the imbalance forming between future demand expectations and realistic production capabilities. The public rarely hears detailed discussions about strategic resource competition because governments prefer maintaining confidence and stability. Openly admitting vulnerabilities in critical supply chains could create panic or accelerate hoarding behavior. Instead, institutions prepare quietly. Long-term contracts are secured. Strategic reserves are considered. Resource partnerships are negotiated behind the scenes. There is also another layer to this story involving currency systems themselves. For decades, the global economy operated primarily under fiat monetary structures disconnected from physical backing. Confidence in these systems depended heavily on economic strength, military power, and trust in institutions. But trust can weaken gradually over time, especially during periods of persistent inflation, rising inequality, and political instability. As confidence declines, nations begin exploring alternatives. Some countries increase gold reserves. Others pursue bilateral trade agreements bypassing dominant reserve currencies. Some diversify into commodities and strategic materials. This trend reflects growing awareness that future economic power may depend less on financial engineering and more on control of tangible resources. Silver increasingly fits into this strategic framework because of its industrial and monetary importance simultaneously. Major institutions are also aware of another dangerous possibility: market dislocation. Modern financial markets rely heavily